Hi, Professor.
Hey Amir, how are you?
Good. How are you? Of
Good, thanks for coming. So
course.
let me share my screen. So I'm kind of curious in your other finance classes. I'm not sure if other faculties covered topics like capital allocation by looking at the utility curves, uh, risk aversion, things like this on the screen.
We went over it like briefly, but like not too much
Oh,
in
okay.
classes.
Well, yeah. Okay. What is that class?
Hold on, I forgot the name of it. Let me look it up because I took it
No
last
problem.
semester.
Yeah, I'm just kind of curious because the topic I'm going to cover is supposed to be very, it's more like theoretical driven. I don't want to bother you guys too much by the, theoretical aspects of the topic, but I do want to, show you how, I mean, the practical implication of this model.
Hi, Professor.
Oh, hey. So any questions before I formally start the lecture? Okay. So if you guys don't have any questions up front, let's get started. So I think tonight, this is gonna be our very last topic for the semester. I mean, next week, I'm going to talk about the role of institutional investors, and some of you request me to talk a bit more about behavioral finance. I appreciate that. So that's gonna be the focus of the lecture next week. And after that, I will give you guys sort of a Q&A. Yeah, that's why I'm saying for the lecture tonight, this is going to be the very last topics selected from your textbook. I think over the, if you look at the Canvas, so basically these are what we have covered so far. We talk about some, conceptual background, different asset classes, and then we move on to financial instruments, including equity, bonds, as well as derivatives options. Okay, starting from last week, we talked a bit about risk return basics from the historical perspective. We talk about some sort of empirical evidence we found. And we also covered a little bit about the regression estimation, which I consider to be a necessary toolbox for the financial analytics. Okay, tonight we are going to talk about the risk-return trade-off and how we form asset allocation and to diversify, the risk through the capital asset pricing model. The reason why I emphasize on the fact of, regression is an important instrument is because it really provides us a toolbox for us to characterize the relationship of whatever variables of your interest. Okay, for example, if you want to look at the student performance against the student attendance, definitely you can extract two data series and run a regression to capture the attendance effect on your performance. Or if you want to look at how the employment rate affects the interest rate, then definitely you can use the regression to capture the association as well. So at a minimum, it gives us a tool for us to describe the relationship of two variables of our interest. Okay, in finance, especially in the asset pricing space, we really care about how the dynamic between risk and return work out for the investor's portfolio management. So we really want to find out a measure that captures the association between risk and return. Okay, so definitely regression is a very meaningful instrument for us to accomplish that, right? Like the capital asset pricing model, we know the beta coefficient, which captures the systematic risk. So basically, if the market risk premium changed by a unit, what happened to the outcome variable, which is your expected stock return, right? So that's captured by the beta coefficient. Okay, so tonight, my agenda is I want to go over a little bit about the details of a regression and ask you guys to work on a sort of a in-class exercise, and then I will jump into the capital allocation and the capital asset pricing model. Okay, sounds good. All right. So last time I showed you up front how we, use the real data to work on the regression technically, but I didn't mention any, the theoretical background behind the scene. Okay. By the way, if you go on to the job market nowadays, most of the job families, they more or less requires you to work on some basic data analysis. If that's the case, definitely this is something I would say a minimum for you to hit the bar. Okay, so yeah, as long as it's something related to basic data analysis, the topic we are discussing right now is really fundamental. Okay, so what is linear regression? Well, I think it's gonna be motivated by this graph. Can you guys see my screen? I think I shared,
yeah.
Right? Okay, awesome. Yeah. So on the screen, here is a two-dimensional scattered plot. Okay. So basically you are, by the way, I try to avoid finance data in the first place because finance data is a little bit hard to visualize. I mean, mentally visualize. I'm using this on the screen using test score and the student teacher ratio, because this is something you can easily to, project in your mind. Okay, so you're looking at two data series. Okay, so let's assume we are looking at the student teacher ratio, which is the size of the class across different sections here in CSU. Okay, on the on the other hand, we have the exam scores of all the sections, corresponding sections. Okay, so we plot these individual data points in something called scattered plot graph, which is shown on screen right now. So basically, you can clearly see the pattern. By pattern, I mean the distribution of this score size relationship. Okay, so for example, if you look at this data point, it basically tells you with a size of 15, that gives you a higher test score performance, which significantly dominate all the other, class sizes, right? So basically, the regression approach allows us to find a minimum squared distance of each individual data point and the fitted line. This fitted line is an artificial thing. It's basically an approach that allows us to capture the trend of the data series. Okay, so the data can be in the form of a time series. It could be a cross-sectional data. It could be a panel data. Okay, so no matter how, as long as you plot the data into this two-dimensional space, you can, come up with a linear trend. At the end of the day, the question is how accurate this linear relation, this straight line characterize the relationship of the two variables you are looking at. Okay, so in other words, what's gonna be the potential measurement error of your estimation? That's a question mark. But no matter how, you can come up with a line that allows you to make your forecast. Okay, so intuitively, if you look at this graph, now let's assume your projection of this linear relationship is correct, 100% correct. Let's assume that's the case. Now we can definitely use this linear relationship, make future forecast. Okay, now I can easily figure out with this, assume the linear relationship, if the size student teacher ratio goes up by a unit, what happened to the test score, right? It's definitely going to drop by whatever percentage. And that percentage is captured by the slope of the line. That's it. Very simple. Okay, now you may ask me, well, maybe that doesn't help us a lot. Well, it's true, it doesn't help us a lot, speaking for the technicals, because, if you look at the statistics, it's basically, we have to rely on some either Excel or programming toolset for us to calculate the coefficients. Otherwise, it's impossible for us to, accomplish this kind of a calculation manually. That's quite labor intensive. So this is a two-dimensional space, and we call it univariate analysis because this is only one variable of interest, and that is the student to teacher ratio. Okay, so in a general sense, this is the the general outlook of a linear regression model. So you have something called y, and that is dependent variable. On your right-hand side, we have an independent variable x. Okay, so basically you plot. You just need to generate a scattered plot of x and y, on the screen, and then figure out the coefficient. And this coefficient over here allows us to make the predictions. Okay, so don't ask me how to calculate the beta. Okay, I don't want to spend 2 lecture times to derive the calculation. That's quite complicated. You can find out. I actually have a note on, sorry, not this one. Okay, ordinary least square regression derivation process, which is quite boring and labor intensive. It demands quite of your linear algebra and the statistics. I try to avoid that. But anyhow, let's take a look of this example again. Now I have a question for you. So can we argue student teacher, the size of the class is the only deterministic factor of the test score? Let me repeat my question again.
No,
So,
I don't, for
yes.
sure not.
Go ahead.
Yeah, I don't think so, Professor.
Okay. Give me a couple other examples.
I guess you'd say.
I mean, what are the
You could,
omitted variables?
you could say seat. I guess I know there's a stretch, but you could say seated position in the class.
Okay.
Like where if they're sitting towards the front or the back. You
Mhm.
could say if they have time outside of class, like if they're working or not working.
Mhm. Yes, definitely.
Study time.
Exactly. The time you put into this class outside of the classroom, right? Yeah. So
Yeah,
so basically the effort you put into this class, not just something the size of the classroom or the size of the magnitude of a student teacher ratio. That's definitely not the single deterministic factor of your exam score. Okay, so the reason why I bring this thing up to the table is that there might be an omitted variable bias for your regression analysis, right? So as you mentioned, there might be some other confounding factors like the attention you allocated to your learning during a class. Where did you sit? And do you have any work prior your lecture time, right? Or how much time you allocated to my course outside of the, the regular class hours. So now, if you look at this regression model, where does those effects, where is it? Does this model capture that? Or which term capture that? Now, trust me, this could be a possible interview question. I guarantee you that's the case. Now, we talk about many omitted variables, right? This is a simple univariate model, which is only one explanatory or independent variable x, and that is the student to teacher ratio. How about other confounding factors? Okay, let me see. It's not captured in the model. That's partially right. So obviously, you didn't explicitly specify those explanatory variables, okay? So in the sense that your confounding factors effect are definitely absorbed by this mu, this error term, okay? This error term will be very huge if in your model you only specify one single variable. Okay, I'm just talking about this example over here. Okay, I'm focusing on this example right now. Okay, so I don't have the real data. Okay, assume if I have, let's assume if we have the data, I guarantee you this error term will be very noisy. Okay, so this brings up something else, and that is your x may not necessarily be a single predictor of your outcome variable. Okay, there might be some other confounding factors which can be possibly captured by your error term. Okay, so this is what we call the endogeneity. So basically, there are some omitted variable, we call it omitted variable bias, that can potentially bias your estimation on the variable of interest. So basically, your beta is not accurate. Okay, and the other big empirical challenge in the real world is you can argue X has some sort of explanatory power of Y, or Y can be explained by X. But how about this? Let's switch the sequence. Okay, so let's run a model like this. X equals beta 0, which is the intercept, plus beta 1 times Y plus the error term. Well, possibly the beta of the Y will be significant as well. So there might be a reverse causality over there, right? So if you are looking at the agricultural economics, people really care about the weather, okay? So definitely weather is gonna be a predictor of, whatever performance of agricultural related products, okay? But if you cannot, reverse the specification, right? Weather cannot be your predicted outcomes, right? So whatever finance performance cannot navigate the weather, despite the fact that there is a significant estimation on the beta coefficient. Okay, so the whole point of this discussion is to motivate you to think, the power of the regression, as well as the challenge associated with regression, okay? So to sum up, regression gives us a way to characterize the relationship of the variables of our interest. However, there might be some sort of empirical challenge. For example, the reverse causality. You can regress the student to teacher ratio onto the test score. There might be a significant relationship, but definitely you cannot argue test score potentially determining the size of the class. Well, it might be though, because of the, I can give you an example. So I was teaching a personal finance class here in the season over the past couple of years. Because of the COVID thing, because of the drop, significant drop of the enrollment, because of the bad performance, we finance department downsized the allocation for the personal finance class openings. Okay, so well, you can argue these two things, the X and the Y, could be jointly determined. So the whole point is sometimes we can find some statistical coefficient, but we cannot argue this thing has some sort of a predictive power. Okay, so this is a caveat before we move on. Now, this is the single unit, this is the univariate estimation. We only have one single X. You can include many other independent variables as well. Okay, but unfortunately, there is no way for you to plot a multi-dimensional universe into a two-dimensional space on the screen. Okay, my point. In other words, if you are looking at three, and let me see if I have that example here. So my point is, if you have more than one independent variables, you can hardly, it's impossible for you to plot this thing on the paper or screen. Let me see. I don't have that. It's okay. Yeah, so on my Canvas, I posted another note, which is in the Word file. So basically, I summed up some key outcomes, key parameters in the regression outputs. Okay, so in finance, we do care about this measurement, which is called R-square. Okay, it basically captures the goodness of fit. It tells you whether your model is whether your model is well specified. Okay, so suppose you get a R-square of 0.8 or 80%. It means that more than 80% of the variation of your outcome variables are explained by the X value, which means that it's actually pretty good. But well, we have to realize the fact that it really depends upon the model specification. The data specification. Sometimes, if you're looking at a panel data which has the time and the cross-section dimension in the same time, usually the R-square is pretty low. Okay. The other thing we want to look at is the standard error. Okay. So basically, it will tell you the significance of the test. Okay, by standard error, there is a transformation of that, and that is the t statistics. Okay, I'll show you in the regression outcome. So usually we want to have t-stat greater than 1.6 or 1.9 or 2.58. This is just an empirical rule of thumb, which tells you whether your estimation has some statistical explanatory power. Okay, so let's take a look at one example. I want to make sure you guys know how to work on it. Okay, so what I want you guys to do is to look at some real estate data from the Federal Reserve data center. Okay, so we want to explore the association between the housing listing price and the something called active listing count. Okay, so basically how many open houses are over there. We also want to explore the housing price and the labor force, because if you look at the time series over the past 2 or 3 years during the COVID times, definitely we were experiencing a labor shortage, right? So it significantly disrupted the construction field. So we can plausibly conjecture labor force, labor participation could be a deterministic factor of the housing price. Okay, so how about this? I'll give you guys like 5 minutes and ask you guys to go to the Federal Reserve data center. You can just Google Fred. Hold on. So I send this link to you guys in the chat box. Go to this website and try to download the data and then run a regression to kind of estimate, hold on, to estimate this relationship. Let's specify the time frame from beginning of 2019 to the most recent data availability. Okay, how's that sound? So I'll give you guys like 5 minutes. Try to work on this. So on Canvas, I have this in-class exercise question on OLS regression. Try to download this data in the first place. These are the variable name in the Federal Reserve data center for the corresponding variables. Okay, I just want to make sure we are comfortable running regressions. Any questions?
Professor, did you say from 2019?
Yes, let's do 2019.
Got it.
So basically 3 years time frame. So notice that on Federal Reserve, usually when we extract the data, we want to make sure the frequency are aligned. Okay, so this is monthly economic data. Okay, by the way, these are what we call the survey data because it's collected from the whatever government agencies. And these are structured data as well. So let's assume it's 2019, first at 2, 23 March 1st. All right. Oh, by the way, I think just now I made a tiny mistake. The active listing count doesn't, well, I'm not sure if it's open house, but at least it captures the level of the housing inventory. It doesn't necessarily need to be open house. Okay, just you know, tiny mistake. And then oh, by the way, when you run a regression, please transform the data to the natural logarithm. Otherwise, the estimation might be problematic. Okay. So I've downloaded the data. You can see there are over the past 3 years, there are, oh, is that 3 year? Actually 4 years. Okay, so there is 50 observations. employees. All right, so let's work on this together. I've already consolidated the data.
Professor, really quickly, when the dates pop up and it pops up as a bunch of number signs, what do you do?
Sorry, I don't understand your question.
When you download the CSV files, I think
I
is what it's
don't.
called.
I download the XLS, but pretty much the same, right?
Right, but when you
If you
download those
double
files, oh, what's up?
if you double tap like between A and B, like the column, and like
Okay,
click twice, it'll open up so that it'll like make the column big enough to read.
got it. Thank you.
Oh, okay.
No problem.
Thank you. Any other questions? Okay. Oh, all right. So this is the price. This is the labor, and this is the inventory. Let me just rename this, columns to make it more readable. All right. So what we want to do is to transform this thing to the log format, because these are all, you can see the magnitude are very huge. The variation, I mean, the extreme value will exert a huge impact on the estimation. Let me see. Inventory. As well as the labor participation. All right, so log. You can see now it's more friendly, right? So we are going to run the regression based on these specified, transformed variables. Okay, so I think as I demonstrated last time in class on Excel, there is a two-pack called data analysis. So you can simply go to regression and then specify the y and the x of your model. So obviously you tell me for the first case, what's gonna be our outcome variable or dependent variable? What is our research question? Whether the inventory, whether the existing inventory or liquidity affects the potential, housing price, or is there a relationship between the housing price and the inventory? All right. So in this case, our y will be the housing price. And our x explanatory variable will be our inventory. Okay, labels means that for the first row, the very first row will be your variable name. So let's select the OLS line fit. We don't need other parameters. And let's see if there's any relationship. Now you can see there is a negative association between the inventory and the housing price. Is that consistent with our economic theory? What do you guys think?
Yes, as the inventory increases, the price decreases
Why? This is very
because there's
easy,
more
right?
supply. Yeah, there's more supply than the
Exactly,
demand.
thank you. So the basic economics 101 class entails the fact that more supply, you know, because the supply curve is upward sloping, right? So if you have more supply, the upward sloping curve will, the supply curve will shift to your right-hand side so that equilibrium market price will be lower. Obviously, there is a negative association over here. Now let's check out the economic impact. All right, so the model parameters are over here. You can see the inventory, the beta coefficient is at the level of 0.2, so 20%. All right, so if the inventory, if the transformed inventory increase by 1 unit, all right, what happened to the outcome variable? What happened to the housing price? Now, obviously, it's going to be dropped by 20%. So this T-stat, you can see, is 6.2. Usually, as long as it's beyond 2.5, it's 1% significant. So it's highly significant. All right. So questions? Oh, okay. Yeah. So yeah, so what I was saying is that this number over here, this parameter captures the coefficient of the economic impact of the inventory or your explanatory variable. This R square you can see over here is only 40%. Okay, given the structure of the data, I would say it's not a very well fit. You can see, just look at this, you know, the scattered plot. It's pretty noisy. Okay, so there is no pattern over here, and it's mostly, I would say, okay, so you can see the portion over here, it seems like largely bias the slope of the line. Okay, if you drop this section over here, it might be a slightly upward sloping as well. So what's the point? Now, so the estimation is really a time varying process. It depends upon the horizon. It depends upon the time span we specified, right? If we implement this estimation during the recession period, definitely it might change the result. And the other thing is, this is a two-dimensional space. We only have one single unit variable over here, and that is the inventory. What if we include a couple other factors over here? So the explanatory power of the inventory might be absorbed. Think about the economic theory behind the real estate economy. What are the main factors of the housing price? Right? Definitely the interest rate, the financing cost, the opportunity cost. Right? The mortgage rate could be a deterministic factor. If we dump that into your model, I mean, this 20% beta will be significantly dropped, or at least the statistical explanatory power will be subsumed by other confounding factors. Okay, so this is a really deep topics in the in the analysis. Okay, so I would say this is a very good live example of the regression. So it basically allows us to characterize the relationship of two variables. At a minimum, it gives us a sense of the sign, the slope of the linear trend of two variables. Right? So I think that might be a bit helpful to motivate the subject. Any questions?
Can you show us one more time how to turn those numbers into the natural log? in
Oh,
Excel?
yeah, sure. Oh, did I stop sharing or? Sorry, yeah. So basically, you just need to equal natural log and referred cell.
Okay, that makes sense.
All right. Any other questions?
Thank you.
So, by the way, I actually deviate a little bit because this topic is not, how to say, is not well covered by the textbook. Okay, the reason why I place a particular emphasis on this topic is because nowadays, if you look at the, those hot terms like data science, data technologies, machine learnings, or forecast, financial forecast, all of this, trust me, this is the starting point. You have to be able to handle OLS regression. I'm not sure if other professors covered this in using lecture time, but trust me, this is going to be a very important direction of your future study. Okay, so after the semester, if you don't know this thing before, please explore whatever open resources to learn this kind of skills. Okay, so definitely lots of things we can look at: how to run the regression, how to run a time series regression, how to run the models like this 1,000 times at the same time. Okay, how to loop around the regression models. Okay, and how to run the rolling regressions. For example, let's say these are the monthly beta, right? Monthly data. Okay, for example, if I just want to specify a regression focusing on the first 5 observations, run the first 5 of the price onto the first 5 observations of the inventory, and I get 1 beta, then I move the window to the next period and get the beta from observation 2 to observation 6, get another beta. So essentially, I have a rolling beta series and extract the average of the rolling beta you estimated. Okay, this is actually how we work on the beta estimation for the capital asset pricing model. Because beta, the systematic risk of the financial market is really time variant, right? Just look at the implied volatility, historical volatility that I showed you the time series when we discussed the options, right? You can clearly see there's a time series pattern of the market risk. So we do want to, develop a variety of models to accommodate our needs. Okay, so let me save this first, and I'll then upload this thing to the canvas. All right, so back to our topic. Oh, by the way, one more quick comment. So Excel has a huge limitation over here. Okay, so if you are still senior or even junior, I recommend you to look at something called Stata if you want to study the regression analysis. This is a fantastic innovation, statistical innovation to run the regressions. Okay, so suppose you have data like So suppose you have a data structure like this. Okay, you have the automobile manufacturer, you have the price of each car, MPG, or whatever characteristics of the vehicles. Okay, you want to implement a regression analysis of your selected variable. For example, if you want to see whether the MPG or so mileage per gallon, it could be a deterministic factor of the vehicle price, or whether it's going to be foreign or domestically made, whether what's going to be the whether there's any association between the price and the weight and the length of the vehicle. Definitely you can use what we were just learned to run the regressions. But the question is, if you want to use Excel to do this, it's just quite labor intensive. You have to go out, find the data, consolidate, merge the Excel spreadsheets, and then transform the data. It's just disturbing. I'm not very comfortable using it. Okay, this data platform allows you to do this in a second. Okay, it's definitely a huge plus on your resume if you just know how to work on this. This is not I wouldn't say it's programming. It's just a statistical analytical platform or software. Okay, so suppose you want to regress the price onto the MPG, then you just run the regression, right? So you can see the output is exactly identical. Speaking of the format, it's pretty much the same with the Excel outcome, right? So you can see there is a negative association with the MPG and the price. Okay, you can also produce the summary statistics of the MPG to see what is the standard deviation of the MPG. It's 5.7. So you can calculate the economic impact of the MPG. So basically 238 times 5.7. That's the economic impact of the MPG on the price. And also you can calculate the summary statistics of the full sample. That just, it's just so easy compared to Excel or other platform. Okay. And you can see there is no coding involved. It's just a couple commands, which is specified by the data. You just need to spend like a week or so to, equip yourself with this kind of technical tools. Okay. So, I mean, you don't need to understand what I was talking about over the past couple of minutes. Speaking of the technical details, the whole point is I want you to look forward, try to explore some powerful softwares. Okay, Stata is my #1 recommendation. And then you can look at some other stuff like Python or R. I mean, these are all advanced. I mean, each one of them are very good. It has its own unique advantage. It depends upon your needs. But Stata is very user-friendly. It's just a low-hanging fruit for you to pick. Okay, if you want to get some statistics or data science type of jobs, definitely this is a huge plus. Okay, now back to our topic for the capital allocation. We want to spend a bit more time, talk about the trade-off between the risk and the return. Okay, we want to talk a little bit about portfolio construction using risky asset and risk asset. Actually, for all the portfolios, you can disentangle them into a combination of the risk asset and the riskless or risk-free asset. Okay, the first thing I want to do is I want to talk about the risk aversion. Okay, as human beings, okay, trust me, if you are a rational human being, definitely we are risk averse. If you still remember the in-class experiment we did at the beginning of the semester, right? I asked you to make the choice across different asset classes. Remember, all of us, we pick the one that is subject to the Ponzi scheme, right? Because we always want more return with less risk. That's human nature. Okay. And also by intuition, sometimes we are more like speculation driven. Okay, so oh, by the way, anyone know what is gambling in a finance sense? I know this is investment class, not gambling class, but I mean, just I want to draw a distinction.
It's a
Yeah.
speculative risk.
Well, can you say that again? You want to speculate on the risk you are taking?
Gambling's a speculative risk, you know, like because you have an opportunity to lose and or gain, you know, whereas like insurance or risk management usually covers pure risks in which there's only an opportunity for loss or no loss, but no gain.
Mhm. Yeah, that's partially right. I think rigorously speaking, for gamble, you really enjoy the risk, right? If it's something certain, let's say if you go to the Las Vegas hotel, if you look at those gambling tables, on the table you didn't see any card or gambling games, all you see is the treasury bills. Are you going to join a game? No, that's not gamble. There's no risk associated with the practice. So I think the significance, the major distinction of a gamble between the traditional investment classes is there is no expected gain to compensate the risk you are going to engage. Okay, so there's no way for you to quantify or it's very challenged to quantify the risk-return relationship in the gambling process. Let me check the chat box. Any? Oh, okay. All right. So, like I said, as long as we are rational individuals, we are definitely risk averse. We don't like risk. And last time we also talked about the this thing over here. Let me show you real quick. Just a very brief recap of the idea of risk averse. So I told you guys this thing over here. So Daniel Kahneman and Amos Tversky invented this theory called prospective theory, which captures the asymmetric payoff of the utility of individual gains and the utility of individual losses. So you can see the utility level, the satisfaction for you to randomly gain $100 is lower than the disutility sourced from $100 loss, which means that we are definitely loss averse or risk averse. There is a little bit distinction between loss aversion and risk aversion, but I mean, this is, I think it's a very similar contrast of this idea, okay? So as human being, we do not like risk. And obviously, the curvature relationship is changing depending upon the level of the dollars of your gain and the loss, okay? So if there is 10,000 loss, definitely, I mean, the slope of this curve will be much steeper, right? It's almost close to a straight line, right? If there's only a dollar gain, definitely, it's very, I mean, you are almost indifferent about this gain or non-gain outcome, right? So yeah, that's what I want to say. Can you guys hear me?
Yes.
I can hear you.
Oh, okay. Yeah, just want to
Yes, we
make
can.
sure. Yeah, sorry about that. So, one way, oh, by the way, your textbook present you a relationship. I wouldn't call this thing to be formula. I just want to use this relationship to tell you there is an association between the utility, expected return, and the potential risk you are engaging. In other words, utility is actually a function of return and the risk. Okay, if you really want to ask me why, how there is a relationship like this, now the answer is this is just an empirical rule of thumb. Okay, it's actually very easy to understand. You can think of this association or function to be an artificial thing. It's just an artificial construct. Okay, so it's gonna be a return minus a coefficient times a parameter which captures the risk aversion level of the individuals times the standard deviation or the volatility. Okay, so now a natural question is going to be, where can we find this investor's risk aversion? Okay, so now I'm not sure if you guys have individual broker account. So most of the account, I'm not sure about Robinhood, at least for TD Ameritrade, Charles Schwab, Fidelity, these accounts I used before. So basically, they all ask you a survey to see, to ask you something like, what's going to be your age, how many years of a working experience you have, how many trading experience you have, what is your salary, how much capital you are managing, $1 or $1,000 or $1 million, right? So basically, they are going, all those, the objective of those survey questions is to measure the investor's utility curve. Okay, because actually this is also a behavioral finance topic. So it turns out young people are more risk-taking, whereas aging or senior investors turn out to be more conservative. This applies to individual investors, applies to hedge fund managers, applies to even institutional investors, firm CEOs. Okay, so definitely utility is a subjective thing. Okay, so unfortunately, traditional economics and traditional finance assume everything under the expected utility curve. But in the real world, human beings are biased, just like the examples we discussed over the last week, right? So clearly, each one of us have individual subjective utility. In other words, it's gonna be challenging to make unbiased decisions. Okay, so I actually think the future directions in the investment could be potentially disrupted by the artificial intelligence. Okay, the reason is that AI is machine. Okay, investors are humans and institutions. Okay, humans are subjective, machines are not. Okay, they are potentially, they can potentially mitigate the subjective biases associated with individual utilities. Okay, so now I would argue in this model or this function over here, this capital A index of investors' risk aversion could be potentially biased from the survey process. Okay, that's why I rarely use this thing in practice. It's just a theoretical construct for me to motivate you to think about the association between utility and risk return trade-off. There is no use for this in practice. So I got a question. Will AI portfolios constructed always be able to outperform individual portfolios constructed? Okay, so that's a fantastic question. I don't have the answer. Sorry, I don't have the answer for the AI portfolios in the future. But right now, I think there's a survey of the AI portfolio performance during the COVID time. The answer is no, okay? Because AI portfolios right now, but sorry, not AI portfolio, automation, AI, this kind of topics are still very young. I mean, it's growing a very fast speed, but still, at the end of the day, it is still a man-made AI portfolio. Okay, it's not a real objective AI portfolio. Okay, that's why it still can hardly beat the market. But I believe in the future it could be, depend upon your techniques, whether you can navigate through your human irrationality. I think that's the deterministic factor. Okay, so I really like the topic of behavioral finance because it's really, it gives us a way to reshape the traditional utility theory. Because at the end of the day, all the investment decisions can be classified into the topic of behavioral finance. Okay, so AI, there might be a fight between man and the machine, or human being and AI in terms of the portfolio construction process. For now, you just check out, I mean, just, okay. I think that's a good practice. Go to the chat GPT, ask the AI, can you beat the market? Okay, let's do that. I didn't ask the question like this, but I would say we may find some interesting result. Okay, so, but based on the survey result, the answer is no. Okay, let me do some research and I'll get back to you next week. I'll find some numbers to support the argument. Okay, that's a very interesting question and that's a very quality topic. I'll come back next week to see whether AI can help us to, overcome some utility problems. I mean, I hope I can give you some answer. It might be some, I mean, it could be an ongoing research question as well. I don't know. So let me do some research and I'll get back to you guys the answer. Okay, I'll mark this question. Okay, so I took the screenshot. Make sure I don't forget. All right. So classical finance textbook over the past 50 years, they will present you this formula, which I feel like there's no use. Okay, maybe I will give you like one number crunching question like this on the exam or homework, but trust me, in the real world, it's not that important. Speaking of the numbers, but okay, don't read me wrong. When it comes to real investment, you do need to assess your capital A, okay? So you need to properly assess the level of your risk taking, but you don't need to be able to calculate the numbers and put that thing into the model. That doesn't necessarily help, but it is very helpful for you to sort out your risk aversion levels. Okay, so this is a screenshot from your textbook. It basically tells you, the utility scores across different level of investors' risk aversions is changing. Okay, and it's a function of return and the volatility. You can see as the volatility is picking up, given the same level of the risk aversion, there is a descending trend of the overall utility because human beings are risk averse. Okay, as the risk aversion goes higher, you can see the overall utility is descending. Okay, so aversion matters and the volatility matters. Expected return also matters. Okay, there is a positive association over here. But most likely, I would say it's really about the volatility that drives the your utility performance. Okay, so risk averse is defined as a positive, capital A, which is the aversion level. If A is greater than 0, we call it risk averse. Smaller than 0, we call it risk loving. And we have a risk neutral assumption as well, if the aversion parameter is specified as 0. Okay, so I do like the graph on the next page, which shows you there is a trade-off between the risk and the return. Okay, so on the screen, the horizontal axis is the volatility. It's the standard deviation of the daily stock return. The vertical axis, the Y, is the expected return. Okay. Now you tell me which quadrant dominant all the others, considering the trade-off between the risk and the return. Do you want data points fall into section 4? Low return, high risk. No. How about section 3? Low return, low risk. Or high risk, high return. Or low risk, high return. Obviously, I think section 1 dominate all the others, right? We want higher return, lower risk. Okay, this is very important. Okay, it is the starting point of the mean variance analysis. Okay, so you can think of the mean to be a statistical measurement of the return of whatever financial instruments. The variance captures the standard deviation, or the distance of the individual data points to the mean. Okay, so it's really tells you the dispersion of the sample. So the variance here is more consistent with the notion of stock return volatility. So basically, you specify the stock's time series and the stock returns time series, and calculate the standard deviation. That gives you the measures for the risk of the stock you are looking at. That is something what we call the standard deviation, the volatility. Okay. All right. So the requirements for portfolio A to be absolutely dominant portfolio B is portfolio A has a lower risk and a higher return. Okay. If it satisfies this requirement, we call portfolio A strictly dominate portfolio B in terms of the mean variance trade-off. Okay. Well, unfortunately, it's very hard to find these kind of portfolios. We have to think about this thing from the portfolio perspective. We have to control for both the return and the risk at the same time. We have to look at the overall expected return, controlling for the given level of a systematic risk. Okay, now let's take a look at this curve over here. We call it indifference curve. So what I mean by that is, overall, we have to plot your utility over here. Okay, this is the utility curve. So in economics, we learn about the utility, right? So it basically tells you the satisfaction. Along the satisfaction utility curve, you are really indifferent about the overall outcome given the risk-return relationship, right? So if you look at this data point, so it gives you a certain level of risk and a certain level of expected return, and moving up, the return is higher, risk is higher. So as the investor, we have to get a clear mind of our indifference curve. Okay, do not single out, do not just try to be in pursuit of the risk. That's dangerous. We have to think about the potential outcome. All right. So the reason why we want to talk about all of this is it has some meaningful implication when we form the portfolio. Let's take a look of this thing on my screen. This is what we call the capital allocation across risky and risk-free portfolios. It's kind of a fancy term, but it's really nothing complicated over here. Okay, look at this example. So suppose we have a portfolio with a total market value of 300K. 90,000 are from money market fund, which is very low risk or risk-free, right? Now, the rest of portion are what we call the total risky asset. So basically are captured by equities and bonds. So you have 113,000 equities and 96,000 bonds. So we can calculate, potentially we can calculate the weight of the equity. How to do that? Well, just use the total market value to scale the level of the equity. Likewise, you can use the now I'm talking about the weight within your risky portfolio. Okay, let's just look at the risky asset portfolio. So basically the total value is 200,000. So basically you are using that number to scale the equity level, and you are using that 210,000 to scale the liability value. That gives you the individual risky portfolio weight corresponding to each instrument. Okay, so the idea is our prior discussion actually matters for the weight allocation process. Okay, by allocation, we are really talking about how we allocate the weight, the size of each financial securities we are investing in, right? So if we are less risk averse, now we probably want to get more equities in our portfolio. If we are we are risk averse, now probably you want to allocate more weight to your bond, right? So it's really about the utility we discussed just now that drives the weighting allocation process. Okay, now we are just talking about the risky portfolio. The next slide is about overall portfolio. Okay, so this is small y captures the weight of the risky portfolio of your entire market value. So look at the last slide. The total risky asset is basically 210,000. The total market value is 300,000. So basically you allocate 70% of your capital to the risky market. The rest of the 30% is allocated to the non-risky asset or capital, which is a money market fund. Okay, out of the entire portfolio, your equity takes for almost 40%. Your bonds takes around 30%. Okay, so speaking of the portfolio or asset allocation process, we really need to think about two weights. One is the weight of your risky portfolio with respect to your entire market value. And the other weight is the weight within your risky portfolio. Okay, by allocation, we are really talking about how we allocate our asset capital across different risk profile. Okay, so in practice, we usually use the treasury bills return, treasury bills yield to characterize the risk-free rate. Okay, I think, yeah, there is another example, which is from your textbook. So this is two asset portfolio, one risky asset and one risk-free asset. You can see it's basically something like this. It's a function of your risk-free asset and the risky asset. Okay, if you rearrange something like that, you eventually end up a relationship which is characterized by this equation. Okay, your expected return of a risky asset and the risk-free asset is nothing more than the summation of risk-free return and the weight you allocated to the risky asset times the difference between the expected return of your risky portfolio and the risk-free rate. Now, can any one of you tell me what is this? Is this something familiar with something we have seen before? Doesn't look at something like a model we discussed before last week? Any thoughts? What is it? Come on, this is a very basic sort of interview question in the equity analysis. So virtually you can disentangle your portfolio to be a risk-free asset and a risky asset. Your expected return will be a function of the return of your two assets. Any thoughts? What is it? Is it similar with the capital asset pricing model we've seen before? Your textbook, the chapter 9 on your textbook discuss a lot about the CAPM detail. So if you look at this, capital asset pricing model basically tells you for individual stock return, you can virtually disentangle this thing to be a function of a risk-free return, return on the risk-free asset, which is the 3-month treasury yield, and the product of two things. One is the expected market risk premium, which is the expected return on the S&P 500 minus the risk-free rate, which is determined through the auction process of the bond market. Okay. Now let's compare this model to what we have seen in the last slide. Are they the same, or at least are they similar? Yes, right? This is portfolio formation. Okay, so basically you can disentangle your stock return from the portfolio perspective into risk-free asset and risky asset. Okay, your risky portfolio is captured by the return sourced from the market portfolio, which is the S&P 500 index return. And that's a combination of a variety of the company's performance. Okay, you are compensated by bearing the market risk, which is proxied by this beta coefficient. Okay, now let me expand the discussion a little bit. The reason why I spent like half hour talking about the regression analysis is the fact that to establish the beta, okay, the price discovery mechanism is really about how we find the beta, how we, use the data to estimate the beta. To do that, we have to use regressions. Okay, we can find a historical return data from Yahoo Finance. Let's say we can easily pull out the price information of the S&P 500 index. We can pull out the historical information of the bond yield from Federal Reserve. We can pull out historical information of inflation or whatever to adjust the parameters. And we can pull out the historical stock return of individual stocks you are looking at. That's going to be your left-hand side. Okay, so you basically regress the individual stock return onto the market risk premium. The coefficient you get from the regression is what we call the beta. Okay, this beta coefficient really captures the market sensitivity, and that is the market systematic risk, which cannot be diversified. Okay, let me repeat it again. Beta coefficient captures the market risk you are bearing. Okay, it captures the sensitivity, which means that if the market risk premium changed by a unit, what percentage change can the individual stock return could be? Basically, it's the beta unit. Okay, so if the market risk premium changed by a unit, your stock return, in this case is the General Electric, will change by beta unit. That's it. Okay, this is capital asset pricing model. You can, another way to think of this thing is you really allocate beta weight, okay, a weight with a magnitude of beta to the market portfolio. Okay. So this is a little bit more complicated. Your textbook, chapter 13, let me see if it's right. Yes, it's chapter 13. Chapter 13 is discussing empirical evidence of security return. I do not plan to cover that in this course because it's very complicated beyond the scope of the this lecture in this semester. Okay, but I want to point out in practice, okay, when we talk about the return forecast models, CAPM, capital asset pricing model is one, but in industry, we do use this thing over here. On top of the market factor, we have two additional factors, okay? And that is the value factor and the firm size factor, okay? So, which means that, okay, so listen carefully. Your stock return minus the risk-free rate, you can actually drop the risk-free rate. It doesn't change a lot in terms of your estimation because it's very low. Okay, so listen carefully. Your stock return is a function of three things only. Okay, the first thing is the level of the market risk premium, which captures the level of the systematic risk. Okay, the second factor, the second deterministic factor of your stock return is the size of the firm. Okay, by size, I mean the market capitalization, which is a product of the market per share, market price per share times the number of shares outstanding. Okay, so it's really about the market capitalization, and it's a time varying process. Firm size is a stochastic process. Okay, it's changing over time. It's random. Okay, the third factor is firm value. Okay, so these three guys, actually two guys, Eugene Fama and Kenneth French. So Eugene Fama is a Nobel Prize winner from U Chicago. Kenneth French is from Dartmouth College. Okay, so these two guys really changed the world by inventing this three-factor model. Okay, so they consider firm value along with firm size and the market risk premium can predict or explain the expected stock return. Okay, by HML, they mean the high book to market ratio minus low book to market ratio. The reason why practitioners focus on book value over market value, or the other way around, is the fact that accounting is on the accrued basis. Okay, finance, we really care about the fair market value. Okay, if the historical book value understate the market value, we consider this investment opportunity set has potential upside growth. That's why this form portfolio on the HML, not HML, market to book. Okay, so we they simultaneously form a long short portfolio. So basically buy the high book to market stocks and simultaneously short book to market stocks. In the meantime, they form portfolios of on the firm size, small firm size minus big firm size. Okay, so these are the factors. After class, I will post two separate videos. Just want to illustrate the idea of the size factor and the value factor. Okay, but actually, let me show you this. Kenneth French, Fama French three-factor model data. All right, so yeah, the data are public. Okay, you can actually download the data over here. This is very interesting. You can pull out the data to see if you can build up potential model with predictive power. I guarantee you can, because these numbers are used by practitioners on Wall Street on a daily basis. Okay, so I think over the past couple years, couple guys from the I think, let me see, Lu Jiang from Ohio State, they have a Q-factor model, which is another model welcomed by the industry people. Okay, I'll post the reading material later. But all of this, they have to use the regression to implement the analysis. So it's really the starting point. Okay, let me see. Oh, by the way, chapter 13 is not required, so there's really nothing you need to be worried about on the test or the homework. But the reason why I mentioned this thing is it's a very important extension to the topic we are covering. Okay, so I'll skip this. These are the assumption for the CAPM. Okay. Oh, by the way, there is one more thing I want to talk about. Oh, I think actually two things. On your homework problem set, I think there is one question regarding the utility specification. Just go over the example on the textbook. You should be fine. It's nothing more than a number crunching game. So the one more thing I want to talk about is this. All right. So we have we mentioned that utility is really about the allocation allocated to the risky asset. Okay, this is at the individual level. All right. So in other words, utility is possibly driven by the level of the risk taking. Okay, I want to ask you at the firm level, if a firm allocate too much risk, allocate too much capital to the risky asset, what's going to be the potential outcome? As the investors, do we want more risk or less risk? So, for example, we are, I think today, we have the earnings report for the Microsoft, Google. I didn't get a chance to, investigate the details. I just know the numbers are good. But as a responsible investor, we have to look at the guidance of the company in the future, right? So, for example, we want to see what's gonna be the investment decisions, capital budgeting decisions of the company over the next quarter or even next couple quarters. Are they going to be risk-taking or conservative? Okay, this is extremely important. If you are not diversified, this is, I guarantee you, this is the single most important thing. We want to be forward-looking. We want to see what's going to be their potential investment opportunity set. Okay. Okay. Finance studies tells you, okay, if a firm incur too much risk, it will undermine the innovation outcome. It will possibly, bias the financing decision outcomes as well. It will induce possibly earnings management, governance issues. It will make the firm to be subject to more on the litigation risk. Okay, Facebook, Meta is a good example. It's a very fantastic high-tech company with lots of innovative ideas. Tesla is also a good example. Elon Musk, you can see over the past 2 years, there are tons of you can call it jokes, you can call it innovative ideas, you can call it random thoughts, but no matter how it push the company risk level at a higher level. So you can see the litigation lawsuit against the company. I mean, there's a lot. Okay, so firm capital allocation to the risky asset versus non-risky asset is really important in terms of the future investment outlook. Okay, now the question is how to mitigate the potential concerns associated with firms' risk-taking decisions. We have to invite the major player of the financial market, and that is the institutional investor. Okay, so I plan to talk about the role of institutional investors over the next week. Okay, so please go to the Canvas, check out the articles I posted on Canvas. There is a module called the role of institutional investors. I posted quite a few articles. Okay, read the abstracts, read the introduction. We will talk about details next week. Okay, so there is chapter 7. We will not cover that because I think it's just nothing more than some conceptual thing. So it tells you the market market portfolio diversification. It's just nothing more than the discussion of a systematic risk versus systematic risk and the firm-specific risk, which we discussed many times during the class. Okay. So one thing I want to mention is it kind of tells you how to calculate the expected return and the expected variance of the portfolio, which is the statistical 101 topic. I wouldn't require you to do that, but there is only one thing I want you to read a chapter after class, and that is the Sharpe ratio. Okay, anyone tell me what is Sharpe ratio? As a finance student, you just cannot leave CSUN without knowing this. So William Sharpe is a professor from UCLA who also won the Nobel Prize because of the invention of this thing along with CAPM. It's really changed the capital market. Sharpe ratio is a rigorous measurement of the risk-return relationship. On the numerator, it's the difference between the expected return of your portfolio and the risk-free rate. The denominator is the standard deviation of your portfolio. What is that? It's just nothing more than return over the risk. That's it. Okay, so back to the discussion over here. We have a capital allocation line. So basically, the slope of the line is the Sharpe ratio. Okay, the vertical axis is the expected return. X is the standard deviation. Okay. And that's the idea captured by the Sharpe ratio. Security market line is another different story. So basically, you essentially regress the expected return on the beta, higher return. You can say expected return is proportion to beta. Higher expected return correspond to higher beta. So the slope of the line is really the capture the potential expected return. Okay, so I just recall there is another thing I forgot to mention. Okay, your textbook also talk about, because of this is a topic regarding the capital allocation. Your textbook discussed a little bit about the passive investment strategies. So basically by passive, it means that you basically invest all your capital in the market index, okay? Because you consider there's no way for you to beat the market. Let's just sit over there for the next 20 years. Then, without changing your portfolios. Okay. So next week, we want to generalize this topic at a higher level. So for institutions, what are their concerns in terms of the passive strategies? So your textbook mentioned there are two important considerations, speaking of the passive strategy, okay? One thing is because active strategy is kind of a costly, to change portfolio is gonna be time consuming and it's labor intensive. But there is a downside associated with passive strategies like free riders. Okay, so there is a wide range of studies in finance and economics called free rider hypothesis. Check out these two guys, Grossman and Hartz. Free rider hypothesis. So they believe in the financial market, there are lots of small free riders. Okay, the idea is M&A, mergers and acquisition, is a very good example. So, M&A usually take a very long process. Empirically, when the news coming out, when the news come up, okay, usually the performance of the target firm will pick up very much. So you can argue the M&A outcome is really the monitoring outcome of long-term institutional investors, whereas short-term investors, they are speculators. However, speculators are able to collect the gain of this M&A deal. They did not enforce any monitoring, or they did not actively engage in the decision process, or they did not actively even monitor or change the portfolios. All they did is sit over there, collect the gains sourced from the M&A deal. Okay, there is a horizon misalignment. Long-term investors really care about the long-term shareholder wealth. Short-term investors, they are only concerned about their potential short-term gain. They are speculation driven. Both of them are sophisticated investors. So passive strategies may potentially induce a free rider problem. Okay, so this is another topic, and that's another motivation for us to invite institutional investors for being the main topics for our lecture next week. Okay, so that's all what I have for tonight, and that's all what I have for the topics from the textbook. The leftover will be the institutional investors and a little bit about behavioral finance. Okay, any questions? Are we good?
Yeah, thank you very much.
All right.
Thank you,
So
Professor.
thank you. Yeah, so by the way, I just want to make sure I posted all the homework problem sets. Just make sure you submit all of them by May 14th or 16th. It's on the canvas. So
And the final will be the same format as the previous test.
yes. May 14th will be the due date for the rest of the problem sets.
Thank you very much.
Okay. All right. If you don't have any questions, I will see you guys next week.
Thank you, Professor.
Thank you.
Thank you.
Hi, Professor. Thank you
Bye.
so much.
Good
Thank
evening.
you, Professor. Have a good one.
Thank you. Have a good one.